Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see, step by step, whether it really deserves a spot in a serious dividend portfolio. Today we're examining Qualcomm Incorporated, ticker QCOM, a global leader in wireless semiconductor solutions and cellular IP licensing that sits at the heart of smartphone connectivity, connected cars, and the expanding edge computing ecosystem. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if QCOM is attractively priced today. How this company makes money. First question, do I clearly understand how Qualcomm Incorporated earns its money, and does that business model make sense for dividend investing? Qualcomm generates revenue through two primary engines, selling semiconductor solutions that enable connectivity and computing, and licensing its intellectual property tied to cellular standards. Cash flow is driven by recurring product refresh cycles, long-duration royalty streams, and sticky customer relationships built on deep engineering and platform roadmaps, not by consumer fads or single product launches. The core earnings drivers are chipsets and platform sales, supplying the hardware that powers smartphones and extends into automotive, industrial systems, and PCs, with demand supported by device refresh cycles and the ongoing need for higher performance connectivity. Licensing and royalties. Device makers pay for access to patented technologies fundamental to modern cellular communication, creating durable, high-margin cash flow resilient even when hardware cycles cool. Expansion beyond handsets, automotive, industrial, and edge ecosystem, wins supported by long design cycles, and the growing need for reliable wireless links across new product categories. Deep customer integration, platform roadmaps, software tools, and proven reference designs strengthen relationships and reinforce repeat business as customers roll into the next generation of devices. In other words, Qualcomm sits at the intersection of device innovation and standardized connectivity, monetizing both the chips that ship and the foundational IP that enables entire product categories, exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. Qualcomm clears that bar with room to spare, showing the classic stair-step dividend pattern long-term investors want in a business shaped by entrenched wireless standards and IP monetization. Annual dividend per share rose from roughly 80 cents in the early 2010s to about $3.50 most recently, with no visible reset or panic cut. For a semiconductor and licensing business exposed to smartphone cycle volatility and periodic inventory corrections, that consistency points to disciplined capital allocation and durable free cash flow generation across very different environments. Step 1 passed, Qualcomm behaves like a genuine dividend eagle with 22 consecutive years of dividend increases that have persisted through multiple technology cycles. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, Qualcomm's revenue moved from roughly the low $20 billion range in the mid-2010s to about $44 billion most recently. The path is not linear. QCOM is influenced by handset upgrade cycles, OEM build plans, semiconductor supply and demand swings, inventory digestion, and the timing of large technology transitions across 4G, 5G, and now on-device AI. But the long-term revenue base has expanded meaningfully, and the licensing stream provides a floor that hardware-only businesses simply don't have. Sales growth past, Qualcomm's revenue base reflects durable platform positioning across handsets and expanding adjacent categories. Second pillar, profit growth, the fuel. Over the last decade, profit generally moved from roughly $14 billion in the mid-2000s to a peak near $25.5 billion, before easing back toward about $24.5 billion most recently. That suggests QCOM is not dependent on one unusually strong year, but operates from a profit base that can reassert itself across changing demand conditions, driven by scale, high-value IP monetization, and platform leverage where R&D investment spreads across large volumes and multiple end markets. Profit growth past, a durable high-margin profit base, protects the payout and funds future increases even through hardware cycle volatility. Third pillar, net income, true strength. Net income starts around roughly $5.7 billion, dips into negative territory near about -$5 billion in a weaker year, climbs into the $9 to $13 billion area in stronger years, and finishes near about $5.5 billion most recently. The important signal is that Qualcomm has stayed profitable in most years across the period and shows an ability to rebound after weaker stretches rather than sliding into sustained decline. Exactly the resilience dividend investors need to see in a cyclical business. Net income past, a resilient earnings profile, reinforces that QCOM's dividend growth is supported by real operating durability, not a temporary upswing. Fourth pillar, dividend payout safety, protecting passive income. Qualcomm's payout ratio has swung from roughly the mid-20% area in stronger years to well above 100% in a stressed period. The spike years are tied to temporary earnings pressure, not a change in dividend policy. The ratio jumps when profits get hit and normalizes when profitability recovers. The broader pattern shows the dividend is not structurally detached from underlying earning power. Dividend payout safety past, the payout ratio has consistently returned to a sustainable range, supporting the view that the dividend is well covered under normal conditions. Fifth pillar, debt burden, avoiding traps. The debt ratio spent much of the decade between roughly the low 0.4s and just under 1.0, finishing near about 0.58 most recently. That suggests a balance sheet inside a workable zone for a scaled technology leader funding heavy R&D and returning cash to shareholders, not a company quietly boxing itself in. Debt burden past, leverage appears managed within a sustainable zone, backed by balance sheet discipline rather than financed at the expense of future flexibility. Qualcomm's overall financial score comes in at a strong level in our framework, signaling an earnings profile and balance sheet built for durability across multiple macro and technology cycle environments. Does it fit our plan? MaxRatio combines three signals: current dividend yield, dividend growth, and financial strength, to classify stocks as growth eagles, balanced eagles, or income eagles. Qualcomm's MaxRatio is 3.25, placing it in the growth eagle bucket. With a dividend yield of 1.83%, QCOM is not an income anchor today. The appeal is in its growth profile. Approximately 37% cumulative dividend growth over 5 years, a manageable payout ratio even through hardware downturns, and 22 consecutive years of increases, reflecting a management team committed to raising the payout through multiple technology cycles. In practice, Qualcomm is a compounder, a modest starting yield designed to grow as licensing income stays durable. Chipset wins expand into new categories, and management raises the payout in line with through-cycle cash generation. It fits investors who want long-run dividend compounding from a high-quality technology franchise and can accept earnings volatility tied to semiconductor and device cycles. Is the stock undervalued today? Here the signals are mixed. Versus peers, QCOM screens as undervalued in the Max Dividends app, suggesting more business strength per dollar invested than many comparable semiconductor and technology names. Versus its own history, the current PE is around 25.57 versus a 10-year average near 17.87, meaning investors are paying above Qualcomm's typical historical multiple, not a bargain entry by its own standards. On yield, QCOM pays about 1.83% today versus a long-term average near 2.40%. The dividend keeps growing, but a stronger share price has compressed the starting yield below its historical norm. Analyst consensus currently points to modest downside from the present share price over the next 12 months, with a wide target range reflecting uncertainty around handset cycle timing, customer concentration, and the pace of expansion into automotive and edge categories. Final decision: Qualcomm is a high-quality dividend compounder priced at a premium to its own history, with a yield below its long-term norm. That can still work well for investors focused on long-run payout growth, but it is not a classic value-style dividend entry. For dividend investors, QCOM makes the most sense as a growth eagle accumulated with a long horizon. A 1.83% starting yield paired with 22 years of consecutive increases and the potential for that payout to keep growing as Qualcomm executes across chipset cycles and expands its licensing and platform footprint. The key watch items are handset cycle volatility, customer concentration, and whether earnings growth catches up to the current valuation multiple over time. Subscribe for more analysis. This is not investment advice.